Hi, and welcome back to the Food Fund. In this video we will be analyzing if Yum Brands stock is a buy. Yum Brands, stock ticker symbol YUM, is just one of many companies we explore on this channel. The Food Fund is focused on all things related to investing in food, beverage, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in great companies. If you love food and love stocks, you will definitely love this channel. We have a lot of goodness to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Yum Brands. Yum got its start in 1977 when Pepsi bought Pizza Hut. In the following years, Pepsi would go on to acquire Taco Bell and KFC. Pepsi would later spin off the three restaurants as a group that officially became Yum in 1997. Today Yum is headquartered in Louisville, Kentucky and employs around 34,000 people. Now let's look at the price action. Starting with the 1-year chart, we see that Yum had a CAGR of about 3%. Zooming out to the 5-year chart, we see that Yum had a CAGR of 7%. Yum share price has steadily risen over time. If we perform a backtest comparison of investing $10,000 in Yum versus the S&P 500, we find some interesting results. In that comparison with the S&P 500, $10,000 invested in Yum would have generated just $16,405 or a 8.9% CAGR versus $17,271 or a 9.8% CAGR if invested in the S&P 500. This demonstrates underperformance for Yum. A Yum investment would have been much more volatile with a 25% standard deviation versus 18% for the S&P 500. Although Yum's best year performance was worse than the S&P 500, the worst year performance of Yum beats the S&P 500. Yum max drawdown, however, was nearly twice as bad as the S&P 500, with Yum having a 41% drawdown and the S&P 500 having a 24%. And surprisingly, Yum underperforms the S&P 500 in comparisons using the Sharpe ratio and the Sortino ratio too. Let's take a look at the fundamentals to find out more. Gross margin is 49%. This gross margin is in line with other restaurants. Revenue has compounded at around 5% over the past 5 years and has reached over $7.1 billion most recently. Here we can clearly see a steady increase in revenue, which when coupled with strong gross margins means the company is showing robust growth. Looking at cash flow, we see a 7% CAGR over the last 5 years for operating cash flow, while capex has grown at a 5% CAGR. As a result, free cash flow has increased at a 7% CAGR. While cash flow has not shown exponential growth, cash flow is steadily increasing. Weighted average shares outstanding have decreased over the last 5 years, going from 329 million shares in 2018 to 286 million shares most recently. Yum is doing a great job buying back shares. In fact, Yum is reducing its share count by about 3% per year. If Yum can keep this up, that means that their share buybacks will beat goal inflation of 2% per year. Nice. Now let's view return on invested capital. Return on invested capital has increased just slightly, going from 41% in 2018 to 42% in 2023. This value seems to oscillate between 31% and 44%, which is actually pretty promising. The fact that Yum's lowest return on invested capital in the last 5 years was 31% indicates a very strong company. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Unfortunately, cash conversion cycle has no data for Yum and Stratosphere. Come on guys, do better. Now, let's look at Yum's debt. The net debt to EBITDA has fallen over the past 5 years and is currently 4.5. This is a bit higher than I would like to see, but it has been trending downwards over time. I would hope that this is where management allocates the company's cash flow. Paying down debt would further improve the fundamentals of the company. Last, let's explore dividends. Dividends are an important factor of investing and can be a key component in compounding. Dividend yield is 1% and the payout ratio is 41%. While the dividend yield is not very high, the payout ratio implies that the dividend is secure. Dividend per share growth over the last 3 years was 10% and the dividend per share growth for the last 5 years was 12%, so the average dividend per share growth seems to be around 10% per year. Not bad at all. The fundamentals of Yum are not too bad. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Yum. It is a restaurant company with a gross margin of 49%. The 5-year revenue per share CAGR is 8% and the 5-year free cash flow per share CAGR is 10%. This is great. Steady growth. A return on invested capital of 42% is great and should stay in the range of 31% to 44% over the next couple of years. Next, the cash conversion cycle is blank because we do not have that data. Sad face. Concerning debt, a net debt to EBITDA of 4.5 means that it takes Yum 4.5 years of earnings to pay down their debt. So much could happen in 4.5 years that this implies some risk from Yum's debt load. This is the largest problem area I have for the company. So from a fundamental standpoint, Yum looks okay but would be much better with their debt under better control. Now let's switch our attention over to valuation. Yum is fairly valued relative to the S&P 500 with a ratio of 1. The price to earnings growth, or PEG ratio, is 1.7, which means that Yum is a bit overvalued compared to their expected earnings. While management has done a pretty good job of growing revenue and free cash flow, having strong margins, and buying back shares, the debt load is really the only area of concern for me. The good news is that the debt seems to be financed at a 3.4% rate so far in 2023. It is unclear whether all of the debt is financed at 3.4%, but the company has over $650 million cash and is profitable, so it is unlikely that they will need to take on more debt. Still, I would like to see them pay off more debt as we enter more economically difficult times. In summary, Yum is a decent company with steady growth. However, there does not seem to be anything that really sets this company apart from the competition. For these reasons, I will pass on adding it to the watch list. Many thanks for watching. What do you think about Yum and its debt load? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.